Is the COMEX lying to us about silver? Right now, inside a vault in New York, something is happening that most investors are not being told. The numbers on paper say silver is abundant. The vaults are filling up. The shortage, they claim, is over. But 7,000 miles away, in Shanghai, buyers are paying an 11% premium just to get their hands on real physical metal. Two markets, two completely different stories. One of them is lying. And by the end of this video, the answer may change the way you think about every ounce of silver you own. Welcome back to Precious Metals Intelligence, the channel dedicated to cutting through market noise and delivering the strategic analysis serious investors rely on. Before this story unfolds, it would mean a great deal to know where in the world this video is being watched from today. Something strange was happening in the silver market, and most people had no idea. At first glance, everything looked normal. Silver prices had pulled back. They were down about 13 to 14% from where they ended in 2025. They were sitting roughly 50% below the all-time high of $121 an ounce, a number many still remembered as the peak of a wild bubble. To most people watching the news, this looked like a simple story. Silver had a big run. Now it was cooling off. Nothing unusual. But something else was going on behind the scenes, and it did not match this simple story. Inside the vaults in New York, silver supplies were growing. The amount of silver sitting in COMEX warehouses was climbing higher, not lower. To many analysts and casual investors, this looked like great news. If the vaults were filling up, that meant the shortage everyone had been talking about must be ending. Some people online were already saying it out loud. The shortage is over. Relax. There's plenty of silver. But not everyone believed that story, and the deeper people looked, the more questions began to appear. Here is what actually happened. In the middle of June, registered silver at COMEX sat around 82 million ounces. Registered silver is the metal that is specifically set aside to settle futures contracts. It is the silver that traders can actually demand delivery on. Just a few weeks later, that number jumped to about 93 million ounces. Now that is an increase of 11 million ounces in less than a month. When people add in another category called eligible silver, meaning metal stored in the same vaults, but not currently offered for delivery, the total pile becomes even bigger, sitting around 326 million ounces. On paper, this looks like a market overflowing with metal. It looks calm, it looks safe, it looks like the fear of a silver shortage was overblown. But numbers on a spreadsheet do not always tell the full truth. Here is the twist that most casual observers missed. The world is not actually short on silver headlines, it is short on silver itself. According to the Silver Institute and Metals Focus, the world has now been in a structural silver deficit for 6 years in a row. That means every single year, people are using more silver than miners are pulling out of the ground. This year alone, the shortfall stands at 46.3 million ounces. So here is the real puzzle. If the world keeps using more silver than it produces, year after year, how can the vaults in New York suddenly be filling up so fast? Where is all of this extra silver coming from? This is the exact moment where the story gets interesting. This is the moment where a simple spreadsheet number stops telling the truth, and something more complicated begins to reveal itself. Some analysts believe the answer is not new silver at all. They believe it is something closer to a trick of accounting. Silver being pulled from a mine in Peru and shipped straight to a vault in New York might look like brand new supply entering the market. But in many cases, it is not new supply at all. It could simply be metal moving from one shelf to another, from the eligible category into the registered category, especially since July is an active delivery month for silver contracts. In other words, the vaults might not be filling up because there's suddenly more silver in the world. They might be filling up because traders are quietly rearranging what was already there. If that is true, then the comfortable story many people believed, the idea that the shortage is over and the danger has passed, may not be accurate at all. It may be an illusion built from paper movements, not real new metal. And if the vaults in New York are not telling the full truth, then somewhere else in the world, a very different and much more urgent story might be unfolding. A story involving real buyers, real premiums, and real physical metal, leaving one side of the globe and rushing toward another. Numbers rarely lie. But sometimes they don't tell the whole story either. To understand what is really happening with silver, analysts say investors need to look past the vault reports and look at something much bigger, production versus consumption. And when they do, a very different picture appears. According to the Silver Institute and Metals Focus, the world is now in its 6th consecutive year of a structural silver deficit. That means, year after year, the world is using more silver than it is mining, not once, not twice, 6 years in a row. This year alone, the shortfall stands at 46.3 million ounces. That is not a small gap. It is a gap that has been growing quietly, while most people were focused on the daily price of silver going up or down. So here is the real question analysts are asking. If the world is short by tens of millions of ounces every single year, how are the vaults in New York suddenly filling back up? How does a market with a supply shortage somehow look like a market with plenty of extra met? While New York looked calm, another part of the world was showing signs of panic. To understand silver in 2026, analysts say people need to picture two very different rooms. One room is in the west, the other room is in the east. And right now, these two rooms are telling two very different stories. Let's start with the west. In the United States and Europe, silver demand has gone quiet. Retail buyers are not rushing to buy. Investors are not lining up. In fact, many are doing the opposite. They are selling. The largest silver ETF in the world, known as SLV, saw over $600 million leave the fund recently. That is roughly 10 million ounces of paper silver being sold off. On top of that, the extra price people pay to buy physical silver eagle coins has dropped sharply. It is now sitting at just $5 to $8 over the spot price. A few years ago, that premium was much higher. What is happening right now, analysts say, is not just a small shift in the market. It is something much bigger. It is a historic split between two very different worlds, the paper world of the West and the physical world of the East. To understand this, it helps to picture two different types of buyers. In the West, most silver trading happens on paper. Big funds, fast-moving computer programs, and everyday investors buy silver through ETFs like SLV. They are not buying real silver bars. They are buying a piece of paper that represents the price of silver. No metal ever changes hands. When these investors get bored or when they see a more exciting stock somewhere else, they simply sell. They exit with a click of a button. Because so much silver trading happens this way in the West, it is the West that sets the daily price of silver. The world watches New York and London to know if silver went up or down that day. But here is the strange part. Very little actual metal moves when these prices change. It is mostly numbers on a screen. Now look at the East. In places like China, the story is completely different. Buyers there are not interested in paper promises. They want the real thing. They want silver they can hold, store, and trust. This demand comes from two places. First, there is huge industrial demand. Silver is used in solar panels, in electronics, and in many parts of green technology. As the world builds more of these products, more real silver gets used up and does not come back. Second, there's personal demand. Everyday people and investors in the East see silver as a way to protect their wealth. They are not looking for a quick profit. They want something physical, something they can trust for years to come. This is very different from the fast, paper-based trading culture in the West. So what does this mean for the overall market? Analysts describe it like water in a bathtub. Picture the West on one side and the East on the other. Right now, the water, meaning the physical silver, is draining out of the West and flowing into the East. The vaults in New York may look full on paper, but in reality, real demand and real urgency are building up somewhere else, far from Wall Street. This does not mean every vault in the world is about to run empty at the same time. That is not how deficits work. A structural deficit simply means that, over time, more silver is being used than is being produced. In the short term, silver can move around the globe, shifting from one region to another based on where demand is strongest that month. Right now, that demand is strongest in the East. This split raises a serious question for investors watching from the West. If Eastern buyers keep paying higher and higher premiums just to get real silver, how long can the West continue to look calm? At some point, physical shortages tend to catch up with paper markets. History has shown this pattern before, in other metals and other moments of crisis. For now, the West holds the microphone. It sets the headlines. It controls the daily price that flashes across every trading screen. But the real story, according to many analysts, is happening quietly in the East, where the demand for real, physical silver refuses to slow down. And that leaves one final question still unanswered. If the East keeps draining real silver away from the West, what happens next? What happens when paper promises can no longer keep up with physical reality?